Webcast is now starting. All attendees are in listen-only mode.
Hi everyone again. My name is Conrad Okongu, and then I'll be taking you through the Riding the Trend season 2. Okay, so we've done the first Riding the Trend, and we had another one which was similar to the first. So this is the second version. Now in the season 2, we hope to go further into the trend. We're trying to get to a point where we are we're so good with understanding the trend of the market and different directions and how to get into different how to get different entries in a particular trend, whether it's an uptrend or is a downtrend. So my advice, first of all, is that you try and see the first video, which was a Riding the Trend. If you have not seen it, the first video is on our website, FXTM website. So ensure you check that video, because I won't cover the information that it's on that webinar here. This is like a follow-up on that webinar. So we'll just assume that everyone watching this video has already watched the season 1, which is Riding the Trend for the first one. So if you have not, no problem. After this webinar, you're going to have the video recorded. Make sure you see the season 1, the first Riding the Trend. That will help you to know where we started from, because we're going somewhere actually. All right, thank you so much. So here we'll be talking about the basic information about the strategy. Now, this strategy can be used in all instruments. It can be used on the major pairs, that's GBP, USD, all the FX pairs, the major ones. The strategy can be used in stocks. The strategy can be used in indices, that's S&P 500 and the GDAX and the UK 100 and the rest. This strategy is also good with gold and silver, okay, and you can also use it in crude oil as well. So majorly, it's a strategy that cuts across a whole lot. It was, as we're going to be seeing today, how we deploy this strategy in different asset classes. Okay, so in the first webinar, we introduced what they call filter time frame, and then we said the filter time frame is just 2 time frames higher than your main time frame. So for example, a trader wants to trade on H4. H4 will be his main time frame. Then it needs to have a second time frame called the filter time frame. Okay, we talked about this extensively in the first webinar, but then so it's just like having 2 charts, 2 views of the same instrument. Let's say I want to trade Euro USD, I'll put it up on GBP on H4, and then I'll put it up on weekly, because that's 2 time frame above H4. So that's how the filter time frame and then the trading time frame, how they are set up. Now, indicators that we're going to use here will be EMA. We started using EMA and MACD, and I'm introducing the RSI this time around. So I'll be introducing the relative strength index. Okay, so it's not a new indicator per se, but so a lot of you already have had a good hands on your RSI, but I'll tell you different ways of how we use it in this strategy. Okay, and the strategy can work on any time frame. Okay, so you can use it on H4, daily, H1, and any time frame that you like. Okay, let's dive into it. So Riding the Trend season 2 quickly. Now, in Riding the Trend season 2, we'll be having multiple entry points within a certain trend. So when we have an uptrend, we're not just getting in at the beginning of the trend. We're looking at how to explore other opportunities in a particular trend. So if you have an uptrend, for example, you have the first entry at the beginning of the trend, and then as the trend progresses, you're asking yourself, which other points can I get into the trend? Have I missed the trend? Can I join if I miss a trend? So these are the questions that season 2 we try to address as well. So it will be looking at multiple entry points inside the trend. Perhaps I missed the entry point. How can I join the trend again? So that's what we'll be looking at. Now, another interesting thing that I will cover in this webcast is how to exit at the peak of a trend. Now you'll be surprised when time you get through this video, through this webcast, you'll be surprised that you can actually predict to a great extent when a trend is collapsing, when a trend is going to be getting to an end. You can actually predict to a great extent. Like, look, this is going downtrend, and then you said, wow, let me know, is it going to be the end of the downtrend? And if it was going up, you said, oh, maybe it's going to be the end of the uptrend. So we'll see how do traders and analysts know that a trend is coming to an end. Why do you want to know if a trend is coming to an end? Because we don't want to be taken unawares. We want to ensure that we pick our profits at the peak of the trend. So we don't want to get to be caught out untimely in the trend, in the market. Trading the stop loss while riding the trend. Now, another thing you're going to learn is how you can shift your stop loss while the trend is going on in your favor. So you don't have to keep your stop loss to where it was, where you entered into the trend at the initial time. You can shift it as you progress. So you can cover up your profit, you lock up your profit, you cover up your profit, and you progress in that manner. So you see, we're getting better. We started with riding the trend season 1, which was just simple entry at the beginning of a trend and all that. Now we're getting into a lot of other advanced concepts of a trend, and that's how we're going to continue even to the season 3 and so on and so forth. Okay, then risk management principles, and then we can wrap up. So let's look at the multiple entry strategies. Opportunity to join an ongoing trend even if you miss an initial entry point. Possibility of multiple positions. So that means for those guys who love to place multiple trades, maybe on a particular time, on a particular pair, this is a good opportunity for you. This is how you can know what how to scale in. They call it scaling in, actually. How to scale in into an ongoing trend. Reversal candle patterns. You need to learn how to use reversal candle pattern. I'm going to bring in 1 or 2 reversal candle pattern in this webinar. Maybe in the next webinar, I'll introduce some more reversal candle pattern. All right. So stay with me. I'm going to take you through all this. Okay. Now let's look at this reversal candle pattern, the bullish pattern. For example, we have this 2 candle pattern. Now, if you look at these 3 patterns, 3 candle patterns, set of patterns that are displayed, you will see that we have the second candle closes higher than the open price of the first candle. Some people call it engulfing. Not all of them are engulfing. All right. Engulfing is when the second candle engulfs completely the first candle. In this situation, you don't have all of the set of the candles engulf each other. Okay. So we have there are 2 patterns, 2 candles. They are just basically 2 candles, the first and the second candle. Now, for a bullish pattern, we have the bullish pattern. For a bullish pattern, the second candle closes higher than open price of the first candle. All right, guys, just stay with me, guys. Just stay with me. Just post a question and stay with me, okay? Now, just watch the patterns I'm showing you. The three patterns, they are similar in one way. Number one, in 3 ways. Number one, there are 2 candles, and then the second candle, the closing price of the second candle is higher than the opening price of the first candle. That is very clear, right? And the shadows are irrelevant. Shadows are the highs and the lows. So the highs and the lows don't really matter. What matters is that the closing price of the second candle closes higher than the opening price of the first candle. And then there are two candles involved in this situation. Okay, so now when you have this pattern, it is called a bullish pattern. It's called a bullish. Just hold on with me. I'm taking you somewhere, guys. Hold on. It's called a bullish pattern. Okay, let me quickly show you example where we use this bullish pattern. Now, look at this downtrend. Look at this down movement of price. This downward movement of price. You can see that at the point we had the our bullish pattern showed up. Our bullish pattern showed up at the bottom of that downward movement. Okay, so if you zoom into that pattern, you see that it had two candles. The second is a bullish, the first is a bearish candle. Now the second candle closing price is higher than the first candle opening price. You see, when this kind of pattern shows up at the bottom of a chart, it's significant. So you have to watch how that works. Okay, all right. So now you can see the effect in this situation. Afterwards, price went up. Let's go ahead. Let's go ahead, guys. We're just building up gradually. Now, the bearish pattern. Bearish pattern has the first candle is a green candle, that is a bullish candle. The second candle is a red candle, that is a bearish candle. Okay, now the second candle closes lower than the opening price of the first candle. You know, if you are used to an engulfing pattern, you would think, okay, maybe it's talking about a engulfing pattern. Yeah, you can say that, but you can see the third candle is not the third pattern is not an engulfing pattern. All right, you can say the second one is an engulfing pattern. Some can argue that the first is an engulfing pattern, but it's not essentially an engulfing pattern. It is that the body of the second candle, which is a bearish candle, goes lower than the opening price of the first candle. Okay, so that's a bearish pattern. So when you have these two in your head or your hands, then you can know what to look out for when the trend is going on in the particular. Now let's see how this is used. Now take a look at this. The market was going up and right and going up and up and up, and all of a sudden we saw these two pair of candles. The first is bullish, second is bearish, and then it looks like the second one engulfed the first one. It looked like the closing price of the first one was lower than the opening price. The closing price of the second one was lower than the opening price of the first one. And immediately after this pattern forms, look at what happened to the market. The market went down. So we want to exploit this pattern. We want to really see how can we utilize this pattern in a trend. How can it help us to get into different things in a trend? All right, guys, just stay with me. Yeah, you can use this pattern on any time frame. Okay, let's hold on, guys. Now, in a trend, you don't understand from the first webinar on riding the trend that I did that you have to get into the trend when the moving average cross each other. Okay, but that's for the first webinar. Now, what I'm trying to introduce here is not the first entry, but the re-entry. I call it re-entry. Re-entry is that let's say you have already entered the trend, or you have not even entered at all, but you want to look for opportunities to enter into the trend again while the trend is going on. Okay, that's what I call re-entry. So we are not talking about entering at the time the moving average is crossing themselves. No, we're talking about getting into the trend as the trend progresses. All right, guys. Now, what are the rules for our re-entry? Now, on your trading chart, which is your main chart now, okay, price must pull back to the moving average. even goes beyond it. This is the first rule. Very, very important, guys. What am I saying? Now look at the example I gave you. The uptrend started here when the moving average 10 crossed above the 20. I can see price was going up, 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 and then it dipped back into the moving average and even went beyond the moving average. So we want it to tear the moving average inside. I mean, to dip into the moving average. All right, guys. So not just touch moving average, we want it to touch the two moving average and even cross to the other side. But then, watch the second rule. But the trend is still intact. It means that despite the pushing in of the candles into the moving average and even crossing to the other side of the moving average, the moving average itself, the 10 is still solidly above the 20 in an uptrend. So it means that the trend is not changing, irrespective of the fact that the candles were piercing into the moving average and even crossing to the other side. So we want to see the candles touch back the moving average and cross to the other side, but then we want the moving average themselves to still be intact, to still be uptrend. Okay, guys, are you following me? I'll give you a lot of examples so you really get this stuff. Now, third condition, MACD is still above zero line. Remember MACD? You have to bring out your MACD now and check. MACD must still be positive. The MACD bars are those blue lines. They must still be pointing upwards. They must still be pointing upwards. All conditions for uptrend must still be met. That is what we're trying to say. All conditions for the uptrend must still be intact. The only thing is that the candlesticks now pierce back into the moving average and even broke out to the other side of the moving average. But everything is still intact. Our moving average is not shaking. 10 is still above 20. Perfect. MACD is still upward, indicating that we are all good in the uptrend. Okay, guys. So we have the three conditions. Now, the fourth condition is that the reversal candle, which is the bullish pattern that I showed you, will now show up. Once the reversal candle shows up, sometimes it shows up around the moving average, or when the candle has pierced the moving average on the other side, the reversal candle will now show up. I'll give you a lot of examples of this. You will really get it. So if you look at the example I have here, the uptrend started up, and then the candle came and pierced into the moving average, piercing into the other side of the moving average. You see, the bottom of the candles were even showing under of the moving average. It means that it was piercing back into the moving average. Now, while it was doing that, MACD was solidly upward, telling us, hey guys, everything is fine, we are still on uptrend. And then the moving average 10 and 20 was still saying, hey guys, it's uptrend, no shaking, everything is fine. Now, what happened is that our bullish pattern, can you see that? Can you remember this bullish pattern? The bullish pattern now showed up right at that point, at that area where the candles were piercing down into the moving average and where all those confluences were happening. We meant to cite this bullish pattern, guys, is a re-entry time. Okay, so for example, now we see this bullish pattern. Now, once the two candles complete their formation, that means the first candle is bearish, the second candle is bullish. Once the second candle closes, I will discover that, oh, the second candle with the first candle form a bullish pattern. Once they are done forming their pattern, then we are clear on that. So the effect is that you will now buy. So the buy rule there is that you buy after the reversal pattern has shown up. So you click to enter your buy. So buy entry is at the close of the second candle, and then you put your stop loss at the least of both of the candles. So you look for the peak of, the least in this case of the two candles, the lowest of the two candles, and then that's where you should put your stop loss. All right. So that's the buy rule. I'll show some examples and then we can go on. Now look at this. Now you see the trend has been going on for a long while. We don't know for how long, because I cut it off. Now you see it dipped back into the moving average, as if the candles were crossing to the moving average on to crossing down the moving average. Now when it dipped down into the moving average, look at what happened. The moment your candles dip into the moving average, just start watching each of the candles. Just start watching each of the candles. Start watching what happens next. But make sure you put your eyes on the MACD as well. Make sure your eyes are also on the moving average 10 and 20 as well. Okay? Just watch what happens as every candle is forming. The moment the candles start to dip into the moving average, when they cross, I love them to cross and get to the other side of the moving average, not just to touch moving average. They should bust into the other side of the moving average. Okay? So the moment it busts into the moving average like this now, from this bullish, this bearish candle, you start checking each of the candles that form. What are you looking for? This is a buy, an uptrend. So you are looking for a bullish pattern. You are looking for two candles that the closing price of the second one, that is a bullish candle, we engulf, or we close higher than the opening price of the first bearish candle. Okay, so this is it, and then it happened here. Eventually, after about 3-4 of those candles going into the other side of the moving average. Mind you, 10 and 20 moving average is still intact. They are not changing direction yet. MACD is still intact. MACD is not changing direction yet either. All right, guys. So then the moment you sight this bullish pattern, then you just jump in and buy. That is the time. So I'm gonna go into all the questions. I just want to quickly rush through the concept, and then we can take all the questions, guys. So just stay with me. And so the moment you have the pattern form, then you have your opportunity to enter again. If you have entered before, you can enter the trend again, having two positions. Okay, that's a good opportunity. If you had not entered before, now you have another opportunity showing in front of you to get into the trend right now. Now, when you enter this time around, your stop loss has to change. Your stop loss will not be the first initial stop loss. For those of you who entered earlier, your stop loss will now be the bottom, the lowest of the two candles. You look for which of the two candles is it the first candle or the second candle? I mean the pattern now, the bullish pattern that got you into that position. You will look for the lowest amongst the two of them, and then that is your stop loss. Is that okay, guys? All right. So you can see that it worked perfectly here. We would have entered our buy here and then put our stop loss here, and then you just enjoy, and then you keep riding on. Now look at this place. There is nothing here. We're not going to enter here because the candle only touched one moving average. It didn't touch the second moving average. It didn't bust out of the moving averages. We want a situation where both of them bust out, not just touch one moving average. We want them to touch the first moving average, touch the second moving average, and then even possibly get into the other side of the moving average. All right, that's what we're looking for. Not just touching the moving average like we have in this case, or like we have in this case. No, we don't want to touch it one moving average. No, touch the two moving averages and bust to the other side, and then when it's jumping up again, you enter. If you have had a position before, you add another position. If you want to, it's optional. Okay, like me, I don't mind. I can put in another position. When I see the opportunity again within the trend, I put in another position. Okay, and then you keep putting in position as much as this pattern shows up in the trend. As long as it keeps showing up, you keep adding positions. Okay. All right. So let's go ahead, guys. Let's ride on. We have a lot to cover. Now, look at another example here. This was a very long trend, a very long and wide one. Now it started from here. So the guys who only watch our webinar 1, this was the only thing they learned. They learned that once the moving average 10 crossed above the moving average 20, you should enter a buy and don't enter again until the end of the trend. That's what they learned, and that's what you learned in the first webinar. But the second webinar, I'm trying to tell you that, look, after the first entry, and then you have another opportunity to enter in this kind of situation, you enter again. Okay, so let's go over the situation again. Now, the uptrend started up, and then the candle came down back and touched the two moving averages and bust into the outside of the moving average. So you see, they came out of the moving average. They came to the opposite side of the moving average. These two candles came out of the moving average. Now, when they came out, as soon as the candles come out of the moving averages, you start watching each of the candles. You start looking at each formation to watch out for the bullish pattern. Okay, so once you get the bullish pattern, which is that you have two candles, one is bearish, one is bullish, the second one is bullish, the first one is bearish, bearish, bullish, and then the bullish candle engulfs the first one. So the bullish candle, that's the second candle now, it goes higher. That means it closes above the opening price of the first one. All right, once you see that on the other side of the moving average, but note, make sure moving average is still intact. That means 10 and 20 is still okay. They are still telling you uptrend, uptrend, go ahead. MACD is still pointing up. The MACD bars, look at the bars, the blue line is still pointing up, telling you all good, all good. So once you have the moving average telling you all good, MACD telling you all good, and then the candle has pierced down into the moving average, and now you have seen that the pattern has shown up, it's time to get in. And when you get in, look at it here again. There are two candles, small candles here, but don't neglect them. They're powerful. As small as these two candles are, they are very powerful. They were the one that caused this uprise. So the moment these two candles formed, they were the bullish pattern we're looking for in the other side of the moving average. We just jump in and buy, and then we'll put our stop loss slightly below the two lows, the lowest of the two candles. Just put our stop loss below it. So it gives opportunity to have very small stop loss. You have very small stop loss, and then you can ride the trend for the second time. You had a first entry here, you have another entry here. If you have opportunity again, you jump in again. So there was no such opportunity here. Let's analyze this one. The candles came to the first moving average, agreed, but they didn't touch into the second moving average. They just touched. They didn't get out. We want them to get out to the other side of the moving average. It didn't happen here, so we leave this one. Now, in this situation, when they came out of the moving average, we never saw our pattern. So this candle came out, but we didn't see our pattern, so we left it. So the only two entries we would have gotten in this trend was the first initial one, and then this one that came second time, and then the two of them would have been in profit for you. All right, let's go on, guys. Now look at this example again. We had an initial uptrend started from here. You would have entered. If you watch our first video, you would have known where to enter, and then you ride on, and then you saw that it came down again, and this time around pierced into the two moving averages, came out of the moving average, and then formed an engulf, formed our bullish pattern. Okay, when we saw our bullish pattern, then we jumped in and buy. Our bullish pattern is that we have two candles. The second one, the closing price is higher than the opening price of the first one. All right, once we have it, it looks like an engulfing. For those of you who have been trading engulfing, you understand this kind of candle pattern, but they are not all engulfing. Just watch out for the two candles. The second one, which is bullish, should go higher than the first one. That means the closing price of the second one, the bullish one, should be more than the opening price of the first one. Okay, so if the EMAs cross themselves, you will just forget about it. We don't want the EMAs to cross. The EMAs must still be intact. They must not cross. In this situation, the EMAs have not crossed, so we will still maintain our position. But if the EMA had crossed here, then we'll forget about entering again. Okay, it's not part of our condition. Our condition says the EMAs the 10 must still be above 20. They must not cross each other to the opposite side. All right, guys, I hope that is very clear. So let's go on. So you have entered another one here. So stop loss should be right at the bottom of the two candles. The peak, the lowest of the two candles. All right, that would have been your okay, let's go ahead. So now we have would have gone up, and then would have had a lot of profit in this situation. Okay, so let's move on. Now we have another situation here. We had a very long bullish candle, a very long candle. When you have this kind of large unusual candle instead of average normal candle size, when you have this kind of candle size, it is not advisable to use it. Okay, you can see this, everything was fine. Would have made profit though, but I just don't like having these kind of candles on the other side of my moving average. Okay, so I want it an average size candle. That's what I want, not a volatile momentum candle like this. No, I want something on the average side of a candle happening at the other side of my moving average. My moving average is still intact. MACD is all good in intact, and then I can go in. So avoid this kind of candles. All right, avoid getting into a trend using this kind of candles. Okay, guys. All right. So let's go ahead. Um, Now let's look at the sell. Let's look at the downtrend. Now we've taken the buy situation. Let's look at the downtrend. Now on the downtrend, the same condition. Price pulls back to the moving average. Now downtrend, the movement is going down. The trend is heading down. You see the moving average 10 is below 20. Everything is going down. Now the price goes back into the moving average. It goes up now this time around. The price candles reverse as if they are going up into the moving average because they are supposed to be going down, but now they reverse as if they're going up. Once they touch the moving averages and then they pierce to the other side of the moving average, you start watching every single candle that forms. You start watching every single candle. You are watching for the pattern, but make sure your moving average is still intact. So the second rule says, but trend is still intact. That means our EMA 10 must still be below EMA 20. Our trend must still be downtrend. That's what this one is saying. Nothing should change. Our trend must still be downtrend. Our MACD must still be downtrend. Our MACD must still be below. MACD should be below 0. Okay, our MACD must be below 0, not above 0. Okay, because on the downtrend, MACD should be below 0. Okay, so the MACD should still be below 0, and then the reversal candle now shows up. We need a bearish pattern this time around. We need a bearish reversal. How does a bearish reversal candle? We have two candles. We have the two candles. Now the first is the bullish, the second is the bearish in this case, and then the bearish now shoot down longer such that its closing price is lower than the opening price of the first candle. Okay, like an engulfing. I'm using engulfing because one of those patterns look like engulfing actually, but they are not all engulfings. Okay, so you sell after the reversal pattern, and then your stop loss will be the highest of the reversal pattern. So you look at the two candles, which of them has the highest price, then that will be your stop loss. Okay, guys, good. So let's go ahead. So we have a sell entry, and then we have a stop loss here, just like we have here. So this would have been another entry for you in the sell, and then you would have gone down. And now I told you this is an opportunity to actually have a smaller stop loss compared to the profit, because the first entry you have a recommended stop loss actually, but this one there's no recommended stop loss. You have to just use the high of the two candles, whichever one is higher in the case of a sell. So there's no recommended stop loss like use 50 pips, 100 pips. No, this one is you have to look for the two candles, which of them has the highest. So put your stop loss there, slightly above that, and then your entry. If you had a stop loss at the first trade, you can modify that stop loss and put it in as the put the second stop, make the second stop loss the same value with that of it. That means you shift your first stop loss to the point of this your second stop loss. Okay, just like a trailing method, like you are changing your value of your stop loss as the market is heading down. All right, so let's go ahead. So let's look at some different examples, and then look at this now. We had a downtrend. I think this was the one we covered here. Okay, so let's look at it. We zoomed in properly. So you see, there was a downtrend coming from here. The candles moved upwards again, like they reversed upwards. They touched the moving averages, pierced out to the other side. We started counting and looking for our pattern. We saw our pattern right around that corner, and then we jump in a sell. Yeah. So, okay, all right, guys. I hope you understand. So I'm saying that MACD is below 0, but trend is still 10 below 20. Okay, it's not above 0, it's below 0. Okay, all right, guys, let's go ahead. So we would have had our sell entry here, and then our stop loss here, and then we ran down, and we continue in that situation. Okay, let's go. Look at another one here. So we have a downtrend running from here. The candle went back into the moving average, pierced into the moving average, and then we started looking for our pattern. We saw it twice here. We saw the first one here, we saw the second one here. Okay, so you can choose any of the two you like actually, and then you put once you enter, you set your stop loss accordingly, and then you write down to your desired take profit, your exit point. Okay, let's go ahead. Now we have another one here, a sell example. You see, we have a downtrend. The price went back into the moving average. Candles went back to the moving average, pierced to the other side. You must wait for the candles to burst to the other side. The candles must start forming on the other side of the two moving averages. Very important. Don't be impatient, guys. You must wait. Okay, like this now. This is fantastic. These two candles were actually forming like on the other side of the moving average completely. So, and then they were also our bearish pattern. The first candle and second candle formed like our bearish pattern, and then we jumped in immediately, put our stop loss right above that, and then you see now again here we saw another similar situation. Price went back into the moving average, went to the other side. The pattern formed again. This is an engulfing this time around, and then we enter the sell. The highest point between the two candles become our stop loss, and then we ride back. So if I had a first entry here, I will have a second entry here, I will have a third entry here. So I actually have 3 entries in this particular trend. Awesome, right? So it helps me to scaling into an ongoing trend. All right, let's go out, guys. Avoid large. I told you before, avoid very large candles. Avoid very large candles. If this pattern shows up as large candle, please avoid it. We just want average size candle or small candle. Average size or small candle. No large candle. Very important, guys. Very, very key. All right. So, trailing stop concepts. Now, reversal pattern at the entry point could serve as a new stop loss. I already said that earlier, and then that means that when you enter this, in a reentry, your new stop loss there becomes the stop loss of all your trades. So if you had 3 trades before, and then there's another re-entry, the new stop loss becomes stop loss for all of the initial trades. I hope you got that very well, guys. Let's say I place my first trade, I have a stop loss. Second trade, I have a stop loss, and I have a third trade, and I have a stop loss. I don't need to keep all the stop losses at the respective points. I can put all of them together as the same value, especially as we are riding into that trend. That's what it means by this. Trend riders manually adjust the stop loss of initial trades to this new stop loss. Yeah. So it's not an auto thing. You have to manually change it. You have to change the value of a stop loss. All right. Okay, let's go ahead. Please note that trailing the stop loss of the initial trade is optional. All right. So that means that what I'm trying to say here is that if you had a trade, first trade, and there's another trade, now you could either change the stop loss of the first one, like I said, to the new one, or you can decide to leave it there. It's optional. I've seen situation where I used the first one and I left the stop loss there, okay, and it was fine. Market didn't really get back there, and I changed it to the second one as well, and it was fine. So it's really we can actually you can actually make it optional. All right. Okay. So I'm coming, Kule, I'm going to get to your question. Victor, I'm going to get to your question. And Balin, I'm going to get to your question. Okay, I'm just building a concept quickly before time goes against me. Now, look at another uptrend. Now, we have an uptrend. Price candle pierced into and goes out of the moving average. And then we have a bullish pattern. That's a bullish pattern, and then we entered. Stop loss is the bottom of the two candles, and then we ride on. We not long after that we saw another situation like that. Price dipped into the moving average again, and we saw a pattern, and then we got in. Our new stop loss is here, and then we continue. Okay. All right, so let's go ahead, guys. Now let's look at the sell. We have a downtrend, price pierced into the moving average. Now this, I would have passed on this actually. I would have passed on this, but I would have taken this one. Okay, because this difference between this and this is that for this situation, the candles pierced correctly into the moving average and burst into the other side. But for this one, they didn't burst into the other side. It was just just touch the moving average. We want it to want the candles to form on the other side. That's the best pattern. That's the best one actually. Um, and then it goes down and down and down. That would have been another entry for us. Our MACD is solidly intact. It's still downwards. Okay, and our moving average must not cross. Okay, all right, guys, let's go ahead. And then this was a buy situation. This was an uptrend situation. And the market has been going up. Price dropped into the moving average again, busted to the other side, and then we have a bullish pattern. Okay, don't forget our MACD must still remain the way it is, and then it went up again, and that would have been our entry for us. Okay, let me take some questions at this point. Pule said again, I discovered that the market ranges nowadays. How can we successfully use this strategy in this present market? Whether it's a range or a trend, Pule, the strategy is not specifically for you can't, like I told them in my class today, you can't tell that the market is in a range except it has gone into the range, or after it has gone into the range, that's when you know. So you can't really tell the market has gone into a range. Okay, so it's best for you not to really bother yourself about whether in a range or in a trend. How would you know that the market is going to be a trend? How would you know that the market is going to be a range before it becomes a range? Okay, so guys, don't bother yourself about some of these things. Once you develop your strategy, backtest it. Once you backtest it and it works for you, all in majority of the market cycle, just use it. All right, that's the same thing I told them today. Okay, we'll use RSI, James. Don't worry. What time frame is best for this strategy? Any time frame. I told you about that. And Moses asked, "Sir, what if I enter on the buy and now return to sell? What should I do when would that happen?" Moses, please rephrase that question. I didn't get it. Jacob said my window is covering the chart. I don't understand that. I'm sure everybody can see my slide. I'm actually displaying a slide now. Okay, on what time frame? I've answered the time frame. How can we use a time frame filter? Okay, everything I'm saying here is not on the filter chart. It's on the trading chart, the main chart. Your filter chart is 2 time frames above your trading chart. Okay, just watch the first webinar, you will see the use of filter chart. I'm not talking about filter chart here. This essentially is for your main chart. All this checking up for the re-entry is on your main chart. Okay, guys. What else? Tafadzwa. Sorry if I don't pronounce that well. How do we have a specific time frames and currency pair? I've told you there's no best time frame, guys. There's no best time frame. All right. It depends on what schedule you have, and sometimes your strategy might prefer to use maybe sometimes a higher time frame. It doesn't mean that it will work on a lower time frame. Okay, but you can use any time frame you like. Just back test it if you can. If you cannot back test it, you can use it on maybe higher time frame. Generally, higher time frames have lesser whipsaws in the market than the lower time frames. Okay, so most traders want to prefer higher time frame, but then that's not my own rule. My own rule is that I can use any time frame I like as long as my strategy works after my back test on that time frame. Okay, guys. So I think okay, I think James said my question is, if our stop loss is hit, does it mean that our setup is wrong? Yep. Your stop loss is if it's a buy, your stop loss is like this situation, the least the lowest of the two candles. Okay, so if your stop loss is hit, just forget about it, guys. All right, yeah. So that's why I said if you have the first trade from the first entry, you can decide to keep the stop loss of that first trade there. But most times, like you can see here, the stop loss of the re-entries don't get hit. Okay, look at it there now. The two patterns formed. I got into this buy. I put my stop loss there. The market didn't come back there. Okay, for a long while. So that's why generally I prefer to put my stop loss in the re-entry. Okay, but okay. Solomon said you do not enter initially at the formation of the trend, but just watching the trend and the bearish and bullish reversal occur. Can I enter the trend? Of course, you can enter. That's why it's re-entry pattern. Two candles must attach moving average. I don't understand what Mijuma is saying. Please rephrase Mijuma. Ibukun is saying, can I use only this strategy for trading successfully? Ibukun, yeah, you can. You can use it. John says, do we just ignore the filter chart once we enter into the market? Exactly, John. You got the idea. All right. So once you get into your chart, filter chart is essentially just for at the beginning of the trend. I mean, at the entry, for the first entry, actually. All right. So that's what the filter chart is for. At this point, I'm not dealing with filter chart any longer. Okay. Um. Okay, Derek, can you join the trend even though the filter chart is going opposite? Yeah, I just said that. I just said that, Derek. Moses, sir, I mean that the ER sometimes I place on the buy position, but later it will return down to sell. So what should I do when that happens? Ah, Moses, I'm still having issues with your question. Jihad, if we use 4-hour time frame, how we avoid the news fear? Stop loss. Jihad, in technical trading, we don't have fear for news. Our solution to news is to use stop loss. Once we have a stop loss, if the news light, let it be tumbling. Once we hit our stop loss, it's supposed to just take us out. So our stop loss would have been calculated properly to suit our risk management desire, or what we want to risk, and then that's it. So you don't have any panic for news or anything. Okay, James again. What's the sign to look out for an early exit? I'm coming to that. Okay, guys. Since we're talking about early exit, I need to. It means that re-entry is no more an issue. So let's move forward. Okay, so I've shown you a lot of examples on re-exit. So let's talk about exit now. Exit is one of the new things I'm adding to this webinar. I know most of this re-entry I treated in the second webinar. So this one is a little different. Now, what I'm trying to look at the opportunity for me to exit at the peak of the trend. I want to exit when the trend is hot, when the ovation is high. You know, before the trend reverses, I want to know, okay, what do I do at this peak? All right. Okay. Indicator we're going to need is called relative strength index, RSI. Right. Relative strength index is an oscillator. Okay, you can get it from your oscillator from your oscillators where you have your indicator list. You go to oscillators and then you will get relative strength index. Okay, I'm coming to that. I'll show you how to use it. So we use it on divergence. So divergence of relative strength index and actual price peak or drop. So if we have divergence of what is happening in our relative on our RSI chart and our price chart, then we take a decision. I'll show you a lot of examples. All right, just stay with me. Okay, so look at this now. Look at the divergence now. Now, let's say we have an upward trend like this now. The market has been going up and up like that. How do we know that from this peak the market will start to go down? I mean, this is the end of our uptrend. How do we know that? That's the question of the exits, the divergence. That's what divergence try to answer in his own way. So how does it work? So what I do is I bring up my RSI chart. When I bring up my RSI chart, and I will look at the peaks of of my actual chart. You see the peak of this chart and then the peak here. So we have two peaks. You see, they are ascending, they are going up. I could draw a line to show that they are going up. You can see the line shows that they are going up. But quickly look at your RSI. Those two peaks correspondingly, look at them, look at the corresponding value or corresponding point on the RSI. You will see that those two peaks are rather coming down on relative times, on relative time. On actual terms, which is the price, they are rising, but relatively they are falling. The new peak relatively is lower than the initial peak. Interesting, right? But on actual term, the new peak is higher on in actual price is higher than the old peak. But in relative to themselves, the new peak is lower. So we would look at this and say, what could be happening? How can price be forming a new peak that is higher than the previous peak, but on relative term, the high peak is not as really strong. It's even lower than the previous peak, and that's the trouble. That's the trouble. That's the trouble. So what that means is, hey guy, this might be signaling the end of that uptrend. That's what it means. That hey, come on, this might really there must be something happening. I mean, how can there be an increase in peaks and then relatively it's dropping? I mean, the strength is lower compared to the previous one, compared to the actual chart. So when you see that, guys, hey, you have to soft pedal. Now you can do a lot of things. You can, like I said here, I said it's not necessarily to close the whole position at the appearance of this divergence. Just close some profits. So learn how to do what they call partial close. I'll probably, if there's time, I'll show you how to do a partial. I'll place a trade and then close some of the trade. You see what I mean by partial close. You just close some profit. Let's say you have been riding, you have made some money, and then you saw these peaks. On the actual chart, the new peak was higher than when there was another peak, and then on the relative chart, the new peak is lower than when there was an earlier peak. When you see that, you just go to your profit. Don't close, don't panic out, don't worry, because sometimes the trend might still continue. But I'm talking about statistically, most times it might signal the end of the trend. I'll show you some examples. So you just partial close. You close some of your profits. Okay, I'll show you how to do quickly how to do partial close. So let's see some more. Let's see. So I said bearish divergence. Okay, I call this bearish divergence because the RSI is bearish. That's what I call it, bearish divergence. Bearish divergence means that when price chart forms consecutive higher tops, that's what I mean by consecutive higher. That means the new top is higher than the previous top. Consecutive higher tops. That's what I mean by that. And then, but the RSI forms consecutive lower tops. So on RSI, the tops are lower consecutively. On the price chart, the tops are higher consecutively. Then that is a bearish pattern, because it means our price is going to go down. It's going to go bearish. That's why I call it bearish pattern. All right, let's go ahead. Now look at example. Oh, sorry. Look at example here. See this upward trend. RSI setting, guy. Fidelis is asking what is RSI setting. RSI setting is default. I didn't want to change anything. I don't want to start giving you rules. Leave it at default. The period is default. RSI setting is default. Okay, we are not concerned about tweaking RSI at this time. We're just looking at the logic, the concept of RSI, what it really means in terms of using it as divergence. So look at this very good example, guys. Look at this very good. It's interesting. Look at this, an upward trend. Originally, if you just look at it, say, this was just going up. All of a sudden, you saw that this was at the point from this height, price just started going down. How could we have known that this was the highest peak in that trend? RSI would have told us. RSI at least would have informed us. Now look at it on the RSI. Let's mark the two peaks that we can spot. Let's mark this peak. Let's mark this peak. Look at it on the RSI. Look at where it is on the RSI. Let's mark another peak. Look at it on the RSI. So as market is forming new peak, Go and be checking it on the RSI. See whether on the RSI the RSI is actually rising as the price chart is rising as well. Check on the RSI as price is forming new peak. Don't just jubilate and say, hey, I'm making more money. Go to the RSI, go and check immediately if RSI is also rising in the same manner as the price chart is rising. So if RSI is rising, then fine, no problem, all is good. But if RSI is dropping, if the peaks of the RSI are lower than the previous peak of the RSI compared to what is happening on your chart, guys, you have to be very careful. You have to be very careful. That's time to start closing up your shop or reducing your lot sizes, doing partial close. Sometimes you might have to close out completely, but then I don't close out completely actually. I just do a partial close and then watch out for my right exit and I exit the market. Any time frame can be used for the exit divergence. All right, guys, let's go ahead. Let's look at this. Look at another one. This one I picked three picks consecutively. The first one, the second one, and then the third one, all consecutively going higher, But it is different story on our RSI. Completely different story on our RSI. On our RSI, they were going lower consecutively. On our main chart, they were rising consecutively. RSI has been notifying us, hey guy, slow down. Even though it's rising on the main chart, it's time to start rounding up your shops, trying to start packing up some profits in, So that's the whole idea of RSI. You're already getting to know that, hey, it's like the trend is wrapping up. All right. So I'm going to go practically to show you how the RSI works. I'm going to go to the chart and I'll do that practically before time is against us. Don't worry, I'm with you guys on this. Now let's look at the bullish situation. Now, there was a downtrend. Look at this downtrend. Fantastic downtrend. Price is just going up and down, and all of it just going down, and then forming new bottoms. But then the bottoms were lower than the previous bottoms. This was lower than this. This was lower than this. Everything is looking like it's going to go down forever. We're just happy. We're like, man, oh, we are making money. We are selling. We are making money. But come on, guys, take a look on your RSI and see what's happening. Take a look on your RSI quickly. On your RSI, you will just see that, hey, guys, see, the bottom of my RSI is not dropping as the main chart is dropping. Rather, the bottom of my RSI is rising. It's telling me market is not going down. It's about to wrap up. It's the time to wrap up. It's the time for me to take my money. Don't panic and close out. It's not advisable, except you just want to close out. What I do is I close on profit. I do partial close. I half my lot sizes, and then I just wrap up. Okay, guys. Okay, I'm gonna do that practically. So I said, when price chart forms consecutive lower bottoms, but RSI forms consecutively higher tops, then there's a bullish divergence. So it means that the market will start going bullish. That's what I mean by bullish divergence. So it is not necessary to close all the whole position at the appearance of divergence. Just close some profit. All right. So don't panic out. It's just telling you that it's about time. It's about time, really, guys. And then that's for some of you who close out completely. I know you are very scared, but it's fine. You can just close some profit, and then let's see if the trend is going to change. Once trend changes, of course, you know how to exit when the trend changes. Look at another one here, very good one. The market was dropping downwards. It dropped lower here. Everybody will have been, wow, but the market is going lower than the previous bottom. Look at the previous bottom. Look at the new bottom. And everybody was like, oh, it's going lower. It's forming new lows. On the news, you are seeing it's forming new lows, and everybody's like, it's going to go down forever. Hey, before you make all that forecast, just come to your RSI and see what RSI is doing. If the strength is not getting stronger, then if the strength is not getting lower as it's on the chart, then you have to be careful. Okay? All right. Okay, so I have to rush up. My time is almost running up. Don't worry, I'll do some more practice. Look at another example. A downtrend, and then we have the two bottoms. the first bottom and the second bottom, but on our RSI, it was rather going up. It was rather going up. There's no time frame, guys. Any time frame works for these things. Okay, any time frame works for these things. Okay, so you can start popping your questions. Let me quickly go to the chart and show you some more examples. Now look at uh look at a chart. Now this is okay. Let me close this RSI first. Let me show you how to bring RSI out. So you go to your indicators list. It's an icon on the top of your MT4. You click it. You go to oscillators. RSI is an oscillator. Then you go down to relative strength index. That's RSI actually. Relative strength index. You click it. Don't bother to set anything. We don't need any parameter. Use the default setting. If you're not sure it's the default, click reset. All right. So once you do that, you click OK, and then it shows me the RSI. I hope the RSI is very clear to all of you. Let me make it thicker. All right. So it shows me the RSI. Now, what I just need to be doing is go and look for the peak values on your chart. Whenever your chart is forming peak higher values, I mean, when it's rising, it came down, it's rising higher. Instead of saying, oh, market is rising higher, just check for that peak value, corresponding value of that peak value on your RSI, and then you compare it. Okay, like now, look at here, we have this point, and then here we have this point. We have 3 times, 1, 2, 3. Let me draw it. Let me draw the line for you on the RSI. The first one is here, the second one was here, the third one was here. What direction is that? Downwards. But on our chart, it was going, price was heading up. But we would have known that, hey, everything is winding up now. It's winding down rather. Market is winding down. By the day, RSI is pointing down, and no long after that, the trend changed. So you would have known earlier before the trend even changed. I'm sure you love this, guys. I'm sure you love this. All right, no problem. Let's go to the next one. Now, look at another one here. I have a downtrend. The market was going down and down and down and down. It formed a bottom here. Pulled up, came lower again. Everybody was like, oh, I know it's going to be a downtrend. It's going to continue to be a downtrend. Hey, calm down. Let's see what our RSI is saying quickly. In our RSI, those 2 bottoms were actually ascending. Those 2 bottoms were actually ascending. But on the main chart, they were descending. On the RSI, they were ascending. What does that tell you? Bullish pattern. That means, hey, guy, the downtrend is winding up now. The market is no more going to be a downtrend. It's likely going to be the end of the downtrend. All right? Okay. Let's take another example. I actually have it on two situations here, 2 trends here. Very interesting. Look at the first one. There was a downtrend here, which has been coming from here. It was downtrend. Everybody was enjoying. The profit was coming. Everybody was happy. And then we had a bottom. We had another bottom. And then we thought that it was going to be bottom forever. It was going to go down and down and down. But when we came to the RSI, we saw that the 2 bottoms, or 3, in fact, 1, 2, 3. Just pick any bottom. You know how to pick. You know what bottom. Bottom is a bottom. Once the market goes down, it goes up. That's a bottom. It comes down again. That's a bottom. It goes up. So you know how to pick bottom. All right. So you just pick the bottom, and the bottom, and then check it on the RSI. See what happened on the RSI. On the actual chart, price was going down. On the RSI chart, price was going up. What does it tell us? Look at what happened next immediately. Change of trend. Change of trend. It would have known right from here that even though the market went down lower than the previous bottom, it was the end of that trend. It was the end of that trend. Okay. So then finally look at this. Uptrend, uptrend, uptrend. We have the peak. We have a peak. This was higher than this. All right. But if you look at the RSI, it was lower. Okay, it went down like this. All right, guys. So you can start popping in your question now. I'll give you some few minutes and then wrap up. I'm sure you love this. Now look at this one. I love this as well. A very long downtrend, a very long one, very, very long. But look at all the bottoms. On RSI, they were actually rising. The bottoms were going down, but actually on the actual chart, but the RSI chart, they were rising. What does that tell us? It tells us that, hey, guy, be careful. This trend is going to change now. And at the last one was higher than the previous, and now when it got to the last one, the trend actually started reversing, and then trend changed. Okay, so guys, this is what I have for you for the season 2. Thank you so much. So I will, if you have a question, you can ask me quickly, and then I will attend to the question. Okay, Gary said on the MT4, how do you do partial profit closing? Oh, awesome, that is good. I almost omitted that. Okay, let me place a trade, just any trade. Let's say I place a trade of one lot. Okay, I hope you are seeing my chart. Let me show you what I did now. I just placed a trade of one lot. Can you see? So let's say I'm making a profit of 42. It's a loss now, but we can't wait for the market because of time. So I'm making a profit. I want to close some of this profit. I will right click on the trade, right click, modify, you click modify or delete order, you click modify or delete order. Now at this place, type where they wrote type of order, you change it from the modify order to instant execution. Now when you change it, you go to your volume where you have your one lot. Now you type the amount you want to close. If you want to close half, you placed one lot initially. Now you want to close half of your profit. It means that you close half of the volume. It's volume that determines what is closed. So if I'm closing half of what I've made, it means I have to half the lot size. That's what it means. So I can change my one lot to 0.5, which means I'm closing 0.5. So when you type 0.5 here, it will close 0.5. At the same time, it will close, because 0.5 is half of 1. At the same time, it will close half of your profit that is already running. That's how to partial close. So once you type 0.5, then you now click close, and that is the end. So you see, it has half my profit or my loss in this case, and then it has half my volume size. That's how to do partial close. All right, it's very simple. You can watch the video again. It's just to do a right click on it, modify or delete, and then change the type of to instant execution, and then type a certain percentage of volume. I mean, a volume size you want to close. So you measure it based on the percentage you want to close. If you want to close half of your profit, close instead. What you do is close half of the volume size or lot size. All right, guys. Can partial close be done on the phone? I guess so. I guess so. Gary is saying, okay, thank you, Conrad, very much. All right, that was very cool. Alex says, thank you so much. It's my first webinar. I learned a lot. Simple and clear. All right, good. So I'm sure you guys love this. So watch out for season 3. We are getting better, guys. We are going to a point where we can really be so wonderful. All right. So that's the idea of the riding a trend strategy. Like I said, if you have not watched the season 1, go ahead. It's still there on our website. You watch it. Sign up for the season 3 when it shows up immediately. All right. I'll see you again in the next webinar. So blessings. Enjoy yourself, guys. I'll talk to you again. Bye bye.